Interpretation of financial statement. Asset turnover ratio. Now, over the past couple of weeks, we've been discussing how to analyze financial statements. So we've discussed gross profit margin, operating profit margin, and return on capital employed. So in this episode, it's now the turn of asset turnover ratio. This is a ratio that compares the revenue of a business to its total asset. Okay, so it is used to determine the amount of sales or revenue generated in relation to its total asset. It also shows the amount generated on a unit of a business's assets in terms of the revenue generated. Secondly, it shows the efficiency of a business's management in the use of the asset. A business normally runs by the use of the assets in its operation. So when we talk about assets, we have the building, you can have machinery, you can have computers, you can have furniture, you can have inventory, cash, receivables. So if a business is not being able to generate enough revenue, it means that the asset is not being used properly. So this also tells potential investors or owners how their monies are going to be used, because the money that they pump into their business will be used into buying assets to run the business. So if it is not being generated revenue enough, there is the likelihood that returns or dividends are not going to be paid to them. So ideally, a company with a high total asset turnover ratio can operate with fewer assets than a company with a less ratio. Let's look at the formula for the asset turnover ratio. This is the net revenue divided by total assets. Here we are now multiplied by 100 because we are talking about ratio. Net revenue is the total revenue less sales returns, discounts allowed, and what have you. Anything that it is related to the revenue coming down must be netted off. Then total asset is the non-current assets and current assets. Everything that has to do with the upper side of the statement of financial position. Okay. Let's look at how to analyze total asset turnover ratio. So ideally, the revenue generated must exceed the total assets value in a particular period. If the ratio that you generate after using the formula is 1.5 and above, it is a desired mark to get. And when you compare your ratio to industry players or prior years and yours is higher, it means that your revenue increased in that particular year compared to theirs. Okay, then it can also mean that there was a reduction in assets, and here care must be taken to analyze it carefully, because a business can manipulate the assets to reduce just for its ratio to increase. Also, when a comparison is done and it is lower, it can be as a result of a decrease in revenue, also known as sales, or increase in total assets. So probably in that particular year, the business has bought more assets that has increased the value of the denominator. Now, this ratio is not sacrosanct. It comes with certain issues. The first of it is that it places emphasis on revenue and not profit. Profit is what is used in measuring the performance of a business, because once you generate revenue, there are expenses that have to be netted off it to arrive at what is going to be distributed to the shareholders. Also, when you deal with revenue, it has more room for manipulation, because a business can sell most of its goods beyond what is desired on credit instead of cash. And once goods are being sold on credit, more customers will come in, increasing their revenue to have a higher asset turnover ratio. Secondly, it is not useful for non-capital intensive industries. For example, for service industries who normally rely on their intelligence and have less capital. When you compare a business in a capital intensive industry, for example, manufacturers who have machines that is supposed to be used in converting raw materials to semi or finished goods, it will not be a reasonable comparison. Thirdly, differences in operational strategies can lead to an analysis not being reasonable. Lastly, different in accounting policies. Because asset is involved, when one company decides to value the asset at cost or historical value, the other is doing revaluation. The one that is doing revaluation is going to have a higher asset value, leading to a lower asset turnover ratio. Alternatively, a business that is using balance method is going to have a higher asset net book value, translating into a lower asset turnover ratio. Let's test our understanding. So we have an extract of the statement of financial position as at 31st December 2020. So we have the assets for 2020 and 2019. So we have the non-current assets, inventory, receivables, cash, leading to total assets of 16,000 for 2020, 14,040 for 2019. So the revenue for the period ending 2020 is $30,000. So we are to calculate and analyze the asset turnover ratio for the year ending 31st December 2020. So when we come to the solution, we restate the formula again, which is net revenue divided by total assets. The total assets turnover ratio for 2020 is going to be 2.00. That was arrived at by dividing the revenue of $30,000 by the total asset of $16,000. This means that the assets that was used generated revenue twice of its value. So for every $1 of an asset of the business used, $2 worth of revenue was generated. And this is a good metrics. Okay, it means that eventually when the asset is being paid off, the shareholders or investors will have some returns coming to them. This can also mean that management is highly efficient. And now you shouldn't just jump into hasty conclusion, because there are certain manipulations that can go on, as we mentioned earlier.